Good afternoon, welcome to Market Wrap number 145. Stuart Williamson here at the helm. Having run through what clients and potential clients are talking about, that's what I've already brought up this week. We do this so many of our clients get bite-sized chunks of information and they can hear a little bit as to what's going on in the marketplace, helps them make some decisions. So this week we're going to look at a couple of things. We're going to reassess what went on with the interest rates going up last week, and then secondly we're going to look at the 18-year market cycle. Is it real? What's happening? So from Knight Frank this week, they comment that the Bank of England raised rates, obviously, by 0.25%. Now, what did it mean and why did they do it? Leaving the rate unchanged would have created doubts about how much economic contagion is still expected from the collapse of the Silicon Valley Bank, SVB, and the Credit Suisse bailout. A rise to 4.5% from 4% would have left the Monetary Policy Committee open to accusations of overreacting to February's surprise jump in inflation, or adding to the pressures within the banking system and wider economy by tightening too quickly. Splitting the difference was going to be the easiest option. So what does it mean to the housing market? In reality, according to Knight Frank, not very much. There has been upwards, downwards, sideways pressure on mortgage rates in recent weeks as lenders have digested the varying implications from the slump in housing sales, February's inflation data, and the mood of caution has entered the swap markets due to events in the banking sector. The good news for buyers is that any rate movements have paled in significance compared to the rollercoaster ride that followed September's mini budget. I mean, the country buying shut down for 3 months. And the overall picture now, as it is in the US, is one of stability. Things are calming down. The latest move by the Bank of England is unlikely to dampen buyer demand, which is proving to be more resilient than expected against an improving economic backdrop. That said, Knight Frank expect prices to fall by a few percent in some parts of the country this year as homeowners transfer to higher fixed rate deals and supply rises from the lows of the pandemic. If you forget the inflation numbers and Credit Suisse for a moment, the latest rise was priced in by lenders, which means that the impact on mortgages will be limited, according to Simon Gammon, head of Knight Frank Finance, which is what we said last week. It's already in the marketplace. Rates are actually falling. He says rates should fall in the longer term, but until we get to that point where inflation and the bank rate have clearly peaked, he suspects lenders will keep tiptoeing up and down with their rates, depending on how confident they are feeling at the time. Together with the rate decision, the Bank of England painted a more favourable economic outlook. It echoed the Office of Budget Responsibility, which issued its own more upbeat economic assessment alongside the budget 2 weeks ago. The bank says wholesale gas futures and oil prices have fallen materially, explaining why it now expects inflation to fall further than it did in February. However, this energy price statement was not news to some economists. And I quote, "The only shocking thing about this statement is that it's taken so long to realise it," said Savas Savouri, the chief economist at the hedge fund Tosca Fund. The bank was as wrong in its outlook as it was late to normalise the base rate. For its part, inflation will end the year markedly and welcomely lower. He doesn't think the turmoil in some markets of the banking sector will spread to the UK mortgage lenders. And he says, neither the events in the United States nor the problem with the Swiss entity pose any real problem to the UK banking sector, which has been welcoming the uplift to net interest income provided the move off the bottom. There is inevitably real pain as rates rise, but Savas says ultra-low rates are a sign that everything is not correct in the wider economy. And he goes on to say, a well-functioning UK economy needs the base rate to be well away from zero, with a figure beginning with a 4 not to be feared by households and businesses, he said. It's the new normal for rates. For those with memories that stretch back beyond 2008, it looks very much like the old normal, certainly does to me. Higher rates are here to stay. In 10 years though, and I guarantee this, we will all have forgotten, it's gone up to 4%, and we'll be quite happy with it. Okay, so let's just move on quickly to the 18-year property cycle. What is it and does it exist? The 18-year property cycle refers to a pattern in property which goes back 200 years. Many property experts believe it as accurate. It is as accurate as it follows a repetitive and historical sequence of events that can be categorized. The property cycle coincides with the business cycle, the credit cycle, and general economic theory of boom and bust. Okay, but how accurate really is it? And we thought we would investigate at APW because we're often criticised as being too positive. So I thought I'd have a look at it and see if it's real. It was first referenced by a guy called Fred Harrison in the UK. This is in a book called Boom and Bust. And in the US it was referenced earlier than this, but he brought it over to the UK. To support the theory, he demonstrated how the cycle repeated throughout 200 years of UK house price data. The market crashes of 53, 54, 71, 72 and 89, 90 support the feeling. He then went on to predict the 2007-2008 crash before it occurred. He predicted it 10 years earlier. But having said that, the financials suggested that anyway. So he could have got that through guesswork. So how does it actually work? The theory suggests that following a crash, the property market experiences 3 to 4 years of recession. Lenders and investors withdraw from the market and demand for property dries up. The result is an abundance of supply planned during the boom draws down house prices. So you do loads of building during the boom, suddenly it stops, bosh, it falls. This is followed by a recovery phase where confidence slowly begins to return to normal and prices steadily increase to 6 to 7 years. According to the research, after the recovery phase there is a market correction where prices pause briefly. The data suggests 1 to 2 years. Perhaps it's because investors are getting nervous about the sustainability for growth. Will it carry on? How many times have I been asked, it can't go on, I'm not buying. This is followed by a boom period where government stimulus and low borrowing fuel demand and supply fails to keep pace. What does that sound like? This results in a strong period of house price growth over 5 to 6 years. A subsequent peak and crash follows and the next cycle begins. So we've had this boom, we've now got the stagnation going on. Doesn't mean a crash is going to come. Let's just look at what drives the boom and bust. The property market is influenced by many things directly and indirectly. The boom and bust cycle has a number of factors contributing to it, including market sentiment, the confidence in the market, i.e. what do we think is going to happen, collective mindset, what does everyone else think is going to happen, scarcity of resources, post-Brexit, perhaps we have that, the media, well no, they're talking it down, supply and demand is a massive shortage of rental, liquidity, the economy, social issues and other pestle factors as we call them. So what areas are first to increase in the cycle? In the UK, it's London and the areas around the capital city that offer the blue chip lifestyle that are first areas to tend to experience booming. Eventually price growth ripples out over the rest of the country. The upturn phase results in property prices leaping forward, and those who get in very early enjoy healthy and substantial price growth. What stops a property boom? Well, the Bank of England wants to control inflation, and a house price boom can result in high inflation which needs to be managed for economic stability. Often this means that the bank raises the base rate, which directly results in commercial banks increasing mortgage rates to slow down the price growth. As demand is halted by this measure, this can lead to a price fall. What are we getting at the moment? High growth, stops, interest rates up, trying to control inflation. Exactly that. Okay, now you talk about having a mid-cycle wobble. Why is that? Property cycle picks up the mid-cycle wobble because they've been growing slowly for 7 years and it tends to drop off. Why is that? It's because people get nervous thinking it can't happen again, especially when they've got the crash at the back of their mind. I mean, in the stock market, 10 years after a crash, there's only 30% of the people left who went through it. It's 30% new people, and there's 30% who are coming into the market now as fresh. So only a third remember what happened. So how accurate is the property cycle? The theories behind property cycles are nothing new. The evidence for Harrison adds time frames though to discussion, which is very good, as the theory is measurable and can be tested using historical data. Boom and bust makes interesting reading for any property investor or economist. And you've got to look at this and say, well, where do we sit within this? You know, what is the effect of unprecedented events like we've had? Harrison goes on to say, it isn't always guaranteed. There's been 2 noticeable events before he wrote his book, which I'm sure he's republished 7 or 8 times. World War I and World War II turned the world upside down and an entire generation. And there's the wholesale destruction of infrastructure. You know, supply chains were completely disrupted, and it was hard for people to recover from that. The role of unprecedented effects also means that the current period is hard to predict. We've had the coronavirus pandemic, and now there's a war in the Ukraine. They've both got massive potential to have already disrupted this trend. So, according to this, when is the next crash due? According to Mr. Harrison, the next crash is due 25-26. This is based on where the last 4 crashes happened: 54, 72, 90, 08. However, due to uncertain times we currently live in, this could be well up in the air, who knows? As can be seen from the last 4 crashes, the contributing factors are not always known at the time of the event, as some only become apparent later on. This means it can be harder to predict when a crash will happen and understand the market. I mean, when they got rid of the monarchy in France, you know, the Russian president was asked, how will it affect? He says, we don't know for 100 years, and we won't know that. What's happened with COVID? Ultimately, we've got to look around and see what's going on. People like the Bank of England, a lot of the research houses are saying there will not be a crash anytime soon. What do we think, APW? It's a nice theory. Take it with a pinch of salt. You know, problem is like anything, when things like this gain popularity, they can become self-fulfilling. An increasing number of investors, especially when it starts to pick up, going, here we go, and people are jumping on. When enough people start to have that plan in mind, don't be surprised if the predictions become real, because they're making it happen. So, there we are. Interest rates are here to stay. The 18-year cycle suggests that London and the South East being flat over the last 5 years might be the start of a new boom coming up. I would say the most simple thing is just to buy where we have ties, as we call it, transport, infrastructure, employment. Buy somewhere with growing employment, with good infrastructure development, with good connections around the country, and you're on a much better bet than buying something with your heart perhaps rather than your head. Look for those sort of places and you'll be cutting down the risks of getting it wrong. Thank you very much. Hope you enjoyed it. Do take care. I think it was Stalin that actually was asked what the abolition of the French monarchy, what effect will it have? And it was him that said we won't know for 100 years. But anyway, please correct me if I'm wrong. Please do comment. Please comment on the cycle and also what we think. Do share. Please, that's what we're here for. Thank you very much. All the best. Cheerio.